Investing in the stock market and real estate are both popular ways to grow wealth, but they differ significantly in various aspects. Here are 12 key differences between investing in the stock market and real estate. 1. Asset type. Stock market. Investors buy shares or ownership stakes in publicly traded companies. Real estate. Investors buy physical properties such as residential homes, commercial buildings, or land. 2. Liquidity. Stock market. Generally more liquid, stocks can be bought and sold quickly on stock exchanges. Real estate. Less liquid. Selling property can take time, depending on market conditions. 3. Volatility. Stock market. Prone to short-term volatility, prices can fluctuate rapidly. Real estate. Prices tend to change more slowly and are influenced by local market conditions. 4. Income generation. Stock market, primarily through dividends, for some stocks, and capital gains, price appreciation. Real estate. Rental income from tenants and potential appreciation in property value. 5. Control and management. Stock market. Investors have little control over company decisions. Management is handled by corporate executives. Real estate. Investors have direct control over property management, renovations, and tenant selection. 6. Diversification. Stock market. Easier to diversify across different sectors, industries, and geographic regions. Real estate. Diversification typically involves owning properties in different locations or types, e.g., residential versus commercial. 7. Entry costs. Stock market. Lower initial investment required. Investors can start with buying a single share. Real estate. Higher upfront costs, including down payments, closing costs, and potential renovations. 8. Financing options. Stock market. Investors can buy stocks on margin, borrowing funds, but typically not advisable for most retail investors. Real estate. Common to use mortgages and leverage borrowing money to purchase properties. 9. Risk profile. Stock market. Higher short-term volatility. Individual stocks can be riskier depending on company performance. Real estate. Generally lower short-term volatility, but subject to economic downturns and property-specific risks. 10. Tax considerations. Stock market. Taxes on capital gains when selling stocks and dividends can vary based on holding period. Real estate. Deductions for mortgage interest, property taxes, depreciation, capital gains taxes on property sales. 11. Time and effort. Stock market requires ongoing research and monitoring. Trading can be active or passive, index funds. Real estate. More hands-on management, especially for landlords, managing tenants, maintenance, and property upkeep. 12. Long-term appreciation. Stock market historically provides good long-term returns, reflecting economic growth and corporate profits. Real estate can appreciate over time due to demand, inflation, and improvements in the property and surrounding area. Understanding these differences can help investors choose which avenue aligns best with their financial goals, risk tolerance, and investment strategy.